It was written in 1961,
Oh,
and at that point, it was to get two, caps, as they were called at the time, versus crowns, $100 per tooth.
ah,
If that were to happen
today,
today,
yeah.
$1,900 per tooth.
Yowza.
Yeah.
Hmm.
So then I said, White Christmas is really popular. I wonder how much it cost when that song was written for a week's stay, say, in Aspen, Colorado. Definitely White Christmas.
Mhm.
We know the movie wasn't done there, but the song was written way before the movie. The song was written in 1942. And at that point, for a stay, you could get a room plus a steak for $1.
Not bad.
For $1.
What year? 1940?
1942.
42.
Now, just the room, not including the steak, $571 a night.
And no steak.
No steak. And then I looked at the classic Five Golden Rings,
Uh-huh.
which was actually written originally in 1780.
Oh, my gosh.
Gold was $19.39 an ounce,
Mm-hmm.
$1,240 an ounce now.
Uh-huh. Actually, gold was not a good investment.
Now or then?
Well, if you look at investing that back then, if the S&P 500 would have been around, you'd have substantially more than that. But that's very interesting.
Yeah.
How
So
time
I
goes on.
thought
And what that points out is how the cost of living changes over time. Many of our clients, when they come to see us for the first time, and we point out the fact what it's going to cost them to live throughout their retirement years, are somewhat shocked.
Yes. I mean, we always factor inflation in, and lately we've been factoring in a higher inflation factor for healthcare because, that is the great unknown now. And healthcare costs seem to be going up at a much faster rate than the other activities of daily living. But inflation has always been something that we've added into the plans, and a lot of people don't even think about that. But it could have a huge impact, especially when you're looking 15, 20, 25 years into somebody's retirement. That could do a lot to change how far your money could go.
Yes.
And looking at whether you're going to run out of money before you run out of life.
Yes. Yeah, it's one of the things that we plan in is when we do financial planning, retirement planning for our clients. We look at where you are and what your spending is, and we don't criticize that. We encourage you to enjoy your lifestyle, but you need to plan for it. And if you don't plan for it, you're going to wake up one day and realize that you've been burning through your money because you didn't realize that's going to cost you more for gasoline, groceries, electricity 10, 15, 20 years into retirement than it does the day that you retire. So that's the tricky thing, and that's what financial planning is all about. And that's what, as I said, the Nancy and I and the 10 other certified financial planners at Certified Financial Group do day in and day out for our clients for a fee. But we are here Saturday morning absolutely free. So if you have any questions, as I said, regarding your personal finances, give us a call. And once again, Laurel, those numbers are
844-220-0965 or text us 21232.
all right. I guess we've got a call there, right?
We
Laurel?
do. We have Mavis on the line.
Hi, Mavis.
Hi.
How are you?
Good, thank you.
Good. What can we do for you?
Well, I wasn't sure if this is your forte, but my husband and I are disagreeing about this.
Okay.
But we live in the state of Florida.
Mhm.
I'm going to be retiring. He's retired. We're doing okay. House is paid off. Blah blah blah. We're going to have a little money if we live okay. But he thinks we don't need a will, and I said, I think we need a will. And he goes, no, only if we were to die at the same time. I said, no, so can you just tell me, or is that even something you do? Just
No, actually,
other people might want to know.
No,
that.
it's a very good question.
Well, first of all, we're not attorneys.
Yes, but if you pass without a will, it's called dying intestate. And the state of Florida will determine for you how your assets get dispersed. And it may not necessarily be the way that you want it to go. They determine who next it would go down. Your assets would go part to him, and then down the line of your succession, it would go to your siblings first. If I'm remembering correctly, I haven't had to deal with anybody who's died intestate for a long time, as opposed to your joint children. So the state of Florida does determine. And then a will says probate me. So a lot of people want to avoid probate. One way that you can avoid any of that kind of stuff is making sure that you have beneficiary designations attached to all your accounts. So if you have a checking, savings, money market, something like that, and it's joint, all you have to do is add either transfer on death or payable on death, and your children or siblings or whomever you would want to get the assets. Any type of life insurance, qualified retirement accounts, you should have primary and contingent beneficiaries. Your house, I
Okay.
would assume, is titled in both of your names.
Mhm.
But if you have no lineal descendants, it all passes to the surviving spouse. But it can be kind of messy because you may have people that are going to show up at the 11th hour and claim something. So having a will is helpful. But as Nancy said, if your jointly owned property automatically passes to the survivor, and there's things that have a named beneficiary, like a life insurance policy, an annuity, a 401k, an IRA, those automatically pass to the survivor regardless of what a will says and regardless of what a trust says. So in some cases, your husband is right. The purpose of the will, as Nancy said, is to give the probate court instructions as to what to do with the things that are in your name alone. And so if you want things to pass on to somebody other than your surviving spouse, you probably should have a will. So it's kind of loose and sloppy not to do it. Some people say I'm going to save some money, but in the long run, settling that estate with the proper documents, and not only a will, I mean, that's the basic thing you need. One of the things that we always encourage our clients to have is what we call a durable power of attorney, right, Nancy?
Well, that and the living will is important also, maybe even more important than the regular standard will. A living will give somebody instructions as to what to do for you for your medical care. If you can't speak for yourself, you add the durable power of attorney on top of that, or give somebody regular power of attorney. This will allow people to act upon your instructions. Feed me, don't feed me, keep me, out of pain, go to the nth degree, don't do anything. Those are the types of issues that end up causing a lot of strife and stress prior to somebody passing away. If you need a referral to a estate planning attorney, just contact our office. There's Murphy and Berglund is who we refer out to most often, and they have great packages that would cover everything, and their fees are extremely reasonable. But it's just basic stuff to take care of. You do it once, it's done, it's over with, and unless there's family dynamic changes, you really don't need to update them.
Does that help you?
That's terrific. I listen to you guys every week.
Well, thank you.
And I just am so concerned about this because my mother had the best thing going. All I did was go to the bank and give the money to my brothers and pay off her bills, and we were good.
There you
Well,
go.
yeah, well, and that's wonderful. And it's just a little bit of planning can take care
In
of
some
that.
cases,
Yeah.
it works. And it gets more complicated if you have real estate outside the state of Florida, because then you may end up with two probates. So, and some folks make the big mistake of putting their kids' names on their assets while they're living, and they lose the step up in basis and ultimately cost them perhaps more taxes than is due. So it's not really do-it-yourself time, because you don't know if you've done it right until it comes time to use it, and then you can't go back and correct it. So the best thing to do is get together with a certified financial planner and or an attorney and work that out. This way, as Nancy said, once it's done, it's done. You don't have to worry about it.
That's terrific. Thank you so much.
You're welcome.
This has
Thank you for the call.
simplified it.
Okay, thanks.
Thank you.
Bye.
All right, if you want to get your questions in just like she did, that's 844-220-0965. Guys, we got about a minute before we're going to go to a rocket launch.
All right, let's see if we can get Matthew's question answered then.
Well, at least we'll talk to Matthew. So, Matthew, what's your question?
Yeah, hi. Thanks for taking my call. My question is, we're going to have 60K soon, and we're planning to last the money for 40 years or so.
Okay.
We have pretty much no mortgage.
Good.
We don't need more than $2,000 per month, around 24K. We're following this 25% bond, 75% index funds.
Okay.
And we do have close to 2 years on saving on a liquid.
Okay.
Okay.
So my question is, the society is talking
Real
about
quick,
you need
real
to
quick,
have.
we're up against the clock here. What do you want? Hang on the phone, Matthew. We'll get back to you. I think you laid the groundwork, but I think we're about to do the launch, right, Laurel?
Yeah, we're going to go into a launch here in just a minute or so. So if you guys want to get in just like Matthew, that's 844-220-0965. Again, 844-220-0965. Matthew, hang on, because they're going to talk to you about your retirement questions. So just hold on. It's just going to be a minute or so here. 844-220-0965 or text us at Planner professionals here to answer your question about your money. All you got to do is give us a call, 844-220-0965. That number again is 844-220-0965. You got retirement questions, you got savings questions, some financial questions, 844-220-0965, or text us 21232. And guys, we were talking to Matthew right before we went into the
Yes,
break.
we cut
Matthew
you
is
off,
still
Matthew.
there?
Yes.
Matthew.
Okay, good.
Well,
All right.
We're
so,
still waiting. We're still waiting on the rocket launch, and we
So
may be
you-
interrupted.
you
It
so-
got scrubbed. Didn't you hear your name
no,
wrong?
I didn't get.
No,
No, I didn't get that. No,
Yeah, it got scrubbed. No rocket
Right.
launch.
All right, no
All right.
rocket.
So Matthew, you built up to the point where you were telling us that you have 2 years worth of cash on hand, which is phenomenal.
He's only spending $24,000 a month too.
Yeah, no, not
I mean, a
$24,000 a
year.
month.
$2,000 a
$2,000 a
month.
month.
Yeah.
It's spending, and that you've come into some cash, and then
What's the rest of your question?
Then we are accumulating close to 600K in our retirements, 457, 401, and Roth and taxable account.
Great, Matthew. How old are you?
So-
How old are you, Matthew?
Right now, I'm 48,
Okay,
Wow,
terrific.
okay.
and I'm trying to at 50 to pull the trigger as far as continuing to work so I can accumulate more based on my lifestyle and our past history. We kind of we are not frugal, but we do, we don't get into the mindset of buying things based on wants
Good for
Okay.
you.
rather than what we need. So I have no problem with staying with the S7 phone versus updating to the new one next year. So kind of we understand the purpose of life in our mindset. So my
Okay.
challenge is the society is telling us something else, that inflation, the money is not going to be worth this much in 20 years. And that's why I'm putting, somewhere around 75% of the money being invested in the market. So with the markets, we're hearing goes up and down. Eventually, a couple of percentage is the inflation, which is calculated based on my 600,000 and my cost of living. So my question is, if I would chose the 24K per year and the 600,000 constantly being invested, 75% of it in the market, would I face any challenges of running out of money? Or as long as I maintained the mindset of, being aware of the finances, I shouldn't have a problem to last this money for at least 35, 40 years.
Okay, I need clarification on one thing. You said at 50 you're going to pull the trigger on retirement. Does that mean that you're going to take advantage of being able to do the extra contributions for being 50 and older?
No,
Or
I'm
you
sorry.
plan on
Stop working?
retiring?
Stop working for money and doing more things like ministries and
I see.
helping
Sure.
volunteer
Okay.
work.
Sure.
All right, so if you are successful in doing that, chances are good you're going to be around for another 30 some odd years past that, which is when you really have to put the money to work for you. So the question is, have you had a plan done looking at all the ifs, ands, and buts of doing that at 50? Not having the income and probably having more expenditures due to travel, I would imagine, depending on where your ministry's duties may take you. And then all the iterations that go on with aging. And I'm looking at, I do my plans to age 90. So you're looking at having this money work for you for 40 years, which is an awful long time. So, having a actual plan with, the numbers in front of you in black and white could unequivocally answer those questions for you. The fact that you have most of your assets in equities now versus income items is fine. You're young, you have time on your side, things will ebb and flow. People are in major panics over the last month because the markets have gone down so much. But if you have been investing over regular periods of time, then you've been buying stuff on sale. So we're getting the high sign that we're running out of time. If you've not had a certified financial planner do a plan for you, then I'm going to suggest that you give us a call and let's sit down and take a hard look and give you some solid answers.
Matthew, if you could hang on after we come back from the news, I've got some other thoughts for you. So we've got a break here, Laurel, right?
Yep.
Okay.
We're going to go into a break here, get some news, weather, traffic. But that means you've got time to get your call in to the Certified Financial Group Planners. If you want to give us a call, is your chance to get free financial advice. Take advantage of it. 844-220-0965. That's the number you got to call in. 844-220-0965. You got questions about wills or about your retirement, about savings. Listen, we all know that's complicated, right? It might be a little bit above our heads. There are no dumb questions here. 844-220-0965. Or you can text us if you're shy. Well, we like your voice, but if you have to text us, 21232. Or one more time, 844-220-0965. On the Money, brought to you by Certified Financial Group. And guys, you've got some workshops coming up here too, huh?
Yes, we do. The first workshop is Saturday, January 19th. All of these are from 9 a.m. to 11 a.m. at our offices in Altamont Springs, all hosted by Gary Abele. The first one is Financial Basics for Life, Strategies for Success, Saturday, January 19th. And then Saturday, February 16th, Healthcare Options in Retirement. Saturday, March 23rd, Will Your Savings Last a Lifetime? And Saturday, April 13th, Countdown to Retirement. All of these workshops fill up really fast. If you go to our website, financialgroup.com, there's a workshop tab. You can just click on that. There'll be a drop down. You pick the workshop. You make your reservation. It's that easy, done, over with. Financialgroup.com.
They are absolutely free. We do them as an educational service. Leave your checkbook at home. We're not going to try to sell you an annuity or some life insurance policy. And the reason for it is we want to avoid you becoming a financial casualty and at the same time introduce you to what we do as a firm. This way, whether you need financial planning now or sometime in the future, perhaps you give us an opportunity to earn your business. So if you want more information about any of those workshops that Nancy mentioned, go to our website. That's financialgroup.com, financialgroup.com. Click on workshops, and you can make your reservation right there online. When we last broke, we had Matthew on the phone. He has since gone, but let's recap what Matthew's situation was. Do you remember how old he was? I knew he retired.
He's 48 now.
48.
And in 2 years,
He wants to go in the ministry.
they want to go into some type of ministry type of business. I got to imagine because he mentioned 457, either him or his wife or both of them work for not-for-profits right now, or for the state. Or government.
So he's accumulated about $600,000. They're living on $2,000 a month right now.
Right.
He has a very good attitude about saving money and not putting his wants before his needs, and believe they live very frugally. And his question was, is he going to be okay? And the point you brought up is the good news is he's young. The bad news is he's young.
Right.
He has about 40 years to deal with. And if you just take inflation, the cost of living for him is going to quadruple by the time he reaches his termination date, somewhere in his 90s.
Right. And he said something about coming into $60,000 soon.
Mm-hmm.
You know, so and he had 2 years worth of savings. So,
Mm-hmm.
but if they're going to be ending up doing some traveling, that $60,000 might best be served left relatively liquid. Also,
You know, the real wild card in his situation is being the age of 50 is health care.
mm-hmm.
What's he going to do? And with a modest income, he could probably qualify for some subsidies on the Obamacare website. I'm assuming that's there. But that is the real wild card.
Right.
Because you could blow through a lot of money if you don't have the adequate coverage. And even if you do have adequate coverage, what's it going to cost you till you get to Medicare age? So those are the things that need to be factored in. But he's to be commended at his particular age for the amount of savings that he has.
Right.
And the ability to continue to accumulate. And he's got a reasonably good allocation of 75% allocated to equities for growth and 25% to fixed income for protection on the downside, like we're having right now. But he's well on his way. He's probably in the top 99% of folks that are listening to this program.
And the most important thing that he mentioned was looking at spending as a need versus a want.
Yes.
I have talked, I think, ad nauseum most weeks when I'm on here about spending, because it's really not how much you earn or how much you can accumulate. It's how you actually use the dollars that make a huge difference.
Exactly.
You know, and I've talked about starting in the back of the store when you're going shopping, because that's where all the sale items are. You know, certainly not like denying yourself, but just being smart at how you're using the dollars, because oftentimes once it's spent, it's gone. There's no getting it back. And people don't look at the spending side of the equation often enough.
And that dollar that you spend today is a multiple of dollars you'll have in the future if you invest it wisely. And one of the best ways that we've said time and time again to accumulate wealth for yourself is to use your retirement plans. use them to the max. Next year, if you're in a 401k plan, the maximum you can put in is $19,000. If you're over the age of 50, it's $25,000. That's the maximum. In addition, if you put that in and maybe you get a match with your employer, you're going to be well on your way. Unfortunately, most people don't do that. They save and invest what's left after they've done the spending, right, Nancy?
Well, that, and when it comes to participating in their payroll deducted plans, they'll look at what the employer will provide for a match, and they will only contribute to that amount.
Right.
What people don't realize is the extra money is going to the federal government, and it could be going in your own pocket in terms of your 401k contribution or 403b contribution. The money's being spent net versus your spendable. And oftentimes when people increase what they're contributing to their payroll deducted retirement plans, it makes little or no difference in their spendable income. Sometimes because it's going to the retirement account versus federal taxes, it may increase their spendable income.
Right. So
Could make life easier now and certainly in the future because they're preparing for it.
the easiest way to save, the easiest way to accumulate money is to put it aside on a pre-tax basis, have it come out of your paycheck or automatic bank draft. You spend what's left, not you save what's left. And that's where the difference is. And that's savings and compounding over years makes a huge, huge difference. Nancy and I have been at this long enough to see it impact our clients' lives, our clients' children, and now our clients' grandchildren that are well on their way to being not financial casualties when they get to be retirement, but hopefully having a comfortable retirement because they understand the benefit of starting early, saving something. And if we're approaching the new year, it's a good resolution maybe to increase the contribution you put in your 401k.
Well, that's true. And then one thing I alluded to really quick before we broke for the potential rocket launch was the markets going down. So while people are accumulating, what we've seen basically since October and over the month of December, I guess the Dow was off 12%. I don't know if it was 12% just for December, the year to date. But anyways, while you're accumulating, if the markets are going down and you have money going into an account over a regular interval, a regular amount, which is called dollar cost averaging, you are constantly buying on sale. So during the accumulation phase, that is one of the best scenarios you could be in. It's almost like a gift.
Yes, yes.
For some reason, we love buying everything on sale except for our investments.
As we say, the stock market's the only market when things go on sale, people run out of the store. I had an interesting circumstance yesterday with a new client came in to see us. We wrapped up his plan, their plan yesterday. He's retired from AT&T in New Jersey. Lovely couple. And he's rolling over his 401k. And we, of course, do the investment questionnaire to determine their risk tolerance and time horizon and so forth. And he graded out as moderately aggressive.
Okay.
When we did the planning, we assumed he'd be should come in at moderate. The numbers will work for him. And we talked about the pros and cons of being more aggressive than you need to be. And his comment was, he says, I remember 2008, 2009, when my coworkers all jumped out, they panicked, they got out of the market, and I talked to some of them lately, and they're really hurting because they never made the right adjustment and got back in.
Right.
And he says, this is the time. He says, I want to go all in now because it's a heck of a lot better now than it was 3 months ago. He says, I want to really go for it right now and then maybe scale it back in the next year or so. I said, certainly it's your money, but he understood the benefit, as you said, of buying when things are sale.
Yeah.
And that's the mentality that you have to have as an investor. Recognize that investments never go straight up. If they did, investing would be easy. It'd be like dieting. If dieting would not be easy and investing would be easy, we'd all be skinny and rich, but it doesn't work like that. And so you have to pay the price. You have to accept the fact that you have volatility, but that's the price that you pay for long-term gains. And so if you're diversified and well invested in the long run, you'll be fine. But the key word here is investing. It's long-term investing. It's not a sprint, it's a marathon, and that's what it's all about.
And another component of what we do is rebalancing our clients' portfolios.
Yes, doing a lot of that right now.
So we're looking at, you mentioned the risk tolerances, where somebody falls, what their attitudes are towards risk, and then what has happened to the ebbing and flowing of their investments. And sometimes it means taking off gains and reallocating around the pie. And selling gains is not a bad thing if it's within a qualified account, then you don't have to worry about the taxes. That's one way to keep them, is to take them off the table.
Yep.
But rebalancing is a huge component of what we do, and it takes a lot of time, but that's what helps protect your investments.
And once again, when we do it as a firm, we do it for a fee. So when you see those transactions in your portfolio, recognize that we're doing it because it's in your best interest, not because it pays us a commission, because the work that we do is for a fee when we do wealth management as investment advisors. So once again, if you have any questions, the good news for you, we still have some lines open, right, Laura? Those numbers are.
We do. 844-220-0965. You can text us if you want. 21232, but it's best to call 844-220-0965. All right, guys.
Okay. So we're up against the break, Laura. I can't see you. How are we doing there?
We have a couple of minutes.
Okay. All right.
If you guys want to talk about some other things.
Well, I mean, there's a week left
Yes.
in the year. So if
Hard to believe, isn't it?
yes, one thing that we were doing was dotting the I's and crossing the T's on required minimum distributions, making sure that we had those done for all of our clients, not just those that are over 70 and a half, but people that have inherited IRAs.
Yes.
If you've inherited an IRA from somebody who's not your spouse, and the person passed away maybe last year, then this year you are required to take a minimum distribution based on your age and the balance of the account as of December 31st, 2017.
Mm-hmm.
If you withdraw for required minimum distribution, there's a 50% IRS penalty.
Mhm.
And, I think everybody knows I'm not a fan of the IRS. And
Interesting thing about the inherited IRA, a little wrinkle there, that if you inherit an inherited IRA, let's say that your mother passed away and left you an IRA, and that's now an inherited IRA,
Mhm.
and you pass away and you leave that to your daughter, that's an inherited IRA.
Mhm.
She has to make those withdrawals based on your
On
life,
my life
on your life
expectancy.
expectancy, not on
Yeah.
hers. So you can't continue that stretch forever. But so there's a little wrinkles that you have to deal with. But Nancy's right. You've got to make those RMDs, because if you don't, the penalties are terrible and you end up sending most of the money to the IRS. So I'm sure your financial advisor, your financial planner has kept you apprised of that. And that's what we do as certified financial planners day in and day out for our clients.
And I've also had some clients with their non-qualified accounts ask me to look at what assets have gains and what assets have losses.
Now, for our listeners that might not be familiar with the term non-qualified, what does that mean?
Something that would be joint with somebody, not an IRA, not a 401k, not a SEP, none of the classic retirement account titles.
That's a non-qualified.
Yes, just a joint account with whomever it may be or individual. So looking at matching up some gains and losses when it comes again to rebalancing, or maybe they need some cash for some end of year, who knows what, we could pull some gains off, match it up with some losses, and make the tax liability smaller, or in sometimes go away completely.
Right. That's how it works. So once again, if you have any questions about anything that's on your mind, the number is 844-220-0965, 844-220-0965.
That's it. And you'll be happy to know that I just went in and upped my retirement savings.
All right.
Yay,
Laura.
yay.
Good for you.
This is On the Money right here on News 96.5 WDBO, 844-220-0965, as they said. We have one more segment coming on up of your free financial advice. You've got questions. Take advantage of this. 844-220-0965 or text us 21232. Right back with On the Money right here on News 96.5 WDBO. Delay. See, I was talking to Tim, and Tim didn't want to be on the air, but he had a question for you guys.
Okay. What's the question?
He has stocks, and he lost some of his stocks earlier, I should say. 80% are like mutual funds. Anyways, he was wondering if it would be better if it was in a fixed bundle.
So he lost
the value?
the value?
I believe that's what he
Okay,
said.
so here's the big difference. I had this conversation with a client the other day who was in a panic because the value of the investments has gone down, which it has for everybody. But until you actually pull the trigger and sell something, and if the investment is of quality, it will recover. But until you sell it, you've not actually lost anything.
Right.
So if Tim has sold his investments, then he's taken a loss. And if peace of mind means to him I need to be into something fixed, then that's a discussion he needs to have with whomever may be helping him or not. But just looking at your statements And seeing the value of your investments going down does not mean that you've actually taken a loss, because you've not pulled the trigger, and we've not pulled the trigger to sell something.
Yeah, you don't really recognize a loss until you sell. And so when you sell, you've locked in those losses. And then the challenge you have is to figure out when to get back in. And a lot of people think, well, I can figure out when to get back in. And that's after everything is improved and markets are up 25%. Now's a good time to get back in.
And you're doing the opposite of what I
Yes.
said. You're not buying on sale.
Yes,
You're
yes,
buying
yes,
stuff,
yes.
at full retail.
Yeah,
as
I
opposed
talked
to
about
wholesale.
I talked about a study that was done recently about being fully invested since 2009 and where you'd have been at the end of or at the start of this year, or if you'd have missed the 7 best days, if you'd have been fully invested in the S&P 500 since the decline in 2009 through the early part of 2018, you'd have averaged just around 10% per year in dividends being reinvested. However, had you missed the 7 best days, in other words, you were sitting on the sidelines waiting, looking for what's going to happen and so on and so forth, your return would have been about 5%. So you've cut your return by 50% by missing just the 7 best days being sitting on the sidelines. And so once again, and there's people out there, and you hear them, Nancy, I mean, they run commercials all the time. They can tell you when to get in, when to get out. Of course, they say if your advisor is advising you to stay put, you need a new advisor and all this stuff. Folks, I want to tell you, Nancy and I have been in this business long enough to know that nobody knows exactly when to get in and when to get out. And you're going to pay somebody some money to try to figure that out for you. Well, good luck. If that person had this magic formula, believe me, they wouldn't be on the radio trying to sell you the magic formula.
Well, and it's time in the market. We
Yes.
do not try to time. We are not traders. We are investors. And, 2008 is the big marker for a lot of people. I mean, when I was on in October and I was talking about my daughter's birthday, I've been in business since 83. I've seen a lot of crashes. But in 2008, most of us looked at everybody's accounts to say, okay, what can we make a weak argument that this is not going to withstand this trauma that's being foretold? And everything else would prevail. I mean, my average client in 2008 went down 21%. And then 2009, they were up 29%. Certainly by first quarter of 2010, everybody was in a break-even and or positive ground.
Right.
The average investor went down 35 to 45%. I mean, that's the difference
That's exactly what
that
I'm
we
talking
can
about.
make.
Yes, yes.
You are an investor. Slow and steady wins the race. I mean, it's not sexy, it's not jazzy, but you're going to be the person that's going to end up like Matthew and having dollars at the end of the line and being able to pick and choose how you live your life in retirement.
Right. And you set money aside for times like this that you need to draw from, and you have a backup plan. In fact, one of the things that we've talked about in shows in the past is there's been a lot of studies done by the Institute of Certified Financial, or the Certified Financial Planners in their journal about the benefit of having a safety net and using a reverse mortgage. Just have it sitting on the side and being able to draw from that when markets are down, so you're not liquidating your investments at a bad time. And I know, unfortunately, reverse mortgages for some folks are taboo because they don't really understand them, and they're not right for everybody. But they can be a real game changer in the right circumstance, where you're not drawing from your investment when things are down. So that's something that you ought to talk to your certified financial planner about, how that might or might not fit in your portfolio, and how it can help you in these unprecedented times.
And cash on hand is really important.
Yep.
I mean, do not underestimate having some actual paper money in your house for emergencies, like when the banker machines and everything don't work because there's a storm and you want to buy yourself a soda or something. And then having a decent, what I call toe of the sock savings account, one that you're not touching unless there's an emergency. Or you have to use it for planned replacement of living expenses.
And every client is unique. And when we draw plans, we look at your own personal situation, look at where you are today, where you want to go, what it's going to take to get there, how to set money aside for those circumstances like Nancy was talking about. And as I said, we do this for a fee at the Certified Financial Group. We're a group of 12 certified financial planner professionals. We do this for a fee Monday through Friday, and we welcome your calls and inquiries. You can find out all about us by going to our website. That's financialgroup.com. Financialgroup.com. You can pull up our biographies. You make an appointment right there online.
We wish everybody a Merry Christmas and a Happy New Year if that's your holiday.
Yes, Merry Christmas to everybody. See you soon.